Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and welcome to today's web seminar. It's our Q&A open house, where I will absolutely be analyzing your stocks, and I'm sure we're going to have a lot of stocks to analyze. But before we get to that, we have a lot of market info to cover, and I'm going to start with the diamonds, which is the Dow Jones Industrial Average ETF, ticker symbol DIA. And, you know, some people turned on the television this morning at around 9:30, and many were surprised. In fact, a few of the anchors on CNBC were almost shocked to the point where they couldn't explain what was going on. The rapid sell-off on the opening was quite incredible. But for those who have been following these web seminars and a lot of the reports that have been going out, especially the weekly market report, there really shouldn't be any surprises. And we've been expecting a big sell-off now for quite some time. In fact, what I'm going to do is I'm going to show you a report that came out on August 13th. If you can see my cursor here, this was August 13th, 2013. And what was happening, now you have to understand that this chart is a 20-year chart. So for the past couple of years, I've been tracking the volatility index against the S&P, and these red arrows show the divergence behind the volatility index and the S&P. In fact, if you're not quite sure what the volatility index is, it's basically a contrarian indicator that measures the emotional, I guess you could say the emotional content, the emotion level of the markets, particularly the S&P 500. And when the volatility index is on the lowest end, and that's down here, you see, again, hopefully you can see my cursor here, this, again, being a 20-year chart, the volatility has been tracking 20-year lows. And the lower the volatility index gets, the more bullish, the more bearish the market gets overall. And I was explaining what was happening with that. Now you can see that this blue dotted line was my projection in what could potentially happen. Now again, this went out 2 years ago. Now, since this report went out, there's been many other reports that I've been putting out on the Market Guys webpage. And I'm calling your attention to this because there's a big lesson to be learned here. If you go back to Facebook here, and I'll show you the Twitter page. If you go to Facebook, here's something that you should all do. Go back to the Market Guys page and look at the timeline and go step by step so you can see the signals and how they've built up to this point. And if you think that the selling is over, it's not. In fact, this is the beginning stages of what could be a downturn that would be worse than 2008. That's my opinion, of course. But in the meantime, you're going to see a series of bounces, which I'm going to talk about as well. The bounces will come periodically as volume increases and decreases. You'll see the volume will be the leading indicator. And here's an alert that went out this morning. I put this out on Facebook, and I also put it out on Twitter. I'll scroll down here. Twitter, if you go to @theoptionsoracle, do the same thing. Look at the tweets. Look at what's happened. Don't be surprised by this market, and you'll see that going back as far as I could even see on Twitter, there's been a series of warnings that I put out. I call that the caution flag, and I go back and I look at the markets and I give that to you. And each one of these market reports have been 100% accurate. In fact, my accuracy on the markets are much higher than individual stocks. And that's a good thing, because if the general indices are showing signs of weakness, we can use that as a defense tool, if you will, or a crystal ball to raise our stops, lighten up on positions, maybe even take bearish positions, and you can go back and learn how to do this on your own. Yes, it's great when someone tells you to do this or that, but I love it when I can teach you things that you'll be able to see for yourself with a simple, chart on your own computer. Okay, so enough with the Twitter, enough with the Facebook. Go back and look at that. You'll get your lessons. Now, another thing that I want to bring your attention to is this is the diamonds. This is the 20-year monthly chart. I'm going to be zooming into eventually the weekly chart and the daily charts, but first the monthly chart. Look at what's happened here since the bottom in 2009. If I take that low and I project to this low or this low and I extend it out just like that, this was the former trend line. Today, in one day, we have broken down below that trend line. So it's game over now for the bulls. What you will see is a series of bounces as the market tests to more or less see whether or not this is real. You'll see recoveries, short recoveries, but each and every time we go through a bounce, you're going to see the market bump its head against the former trend line. On the Market Guys website, there's a video. Again, for those who are new, go to marketguys.com. There's a video on the roll reversal. And most of the time I draw horizontal lines to show roll reversal support or roll reversal resistance. Well, trend lines have that same effect. The roll reversal will be a big factor here in our strategies as we move more towards bearish strategies. So what happens is once a support level, aka the trend line, has broken, the market will make an attempt to get back up to retest to see if we can get back on track. When that doesn't happen, it'll bump its head against that former trend line, which is now resistance, and it'll start going lower. And again, I don't think this is going to happen all in one day. It's going to be a series of high volatility days or very high volatility weeks. And in between these moves, these more or less legs of the market, we will actually be able to make money. Now, if you're not an option trader or you've never learned how to make money on the way down, understand that there are contra funds or bear funds. These are instruments. These are investment instruments that have been put in place for investors who never shorted in their life. And what this does is, for instance, the bearish funds that are out there right now, they go up in value as the market goes down. So you still get to buy things and feel like you're buying on the long side, but in fact what you're doing is you're buying into a short position. And if you've never traded those before, start investigating that and learn about it so you feel comfortable with it, and then watch. Slowly but surely, you'll see how you can make money even on the way down, sometimes even faster. Now, here's a 20-year chart of the spiders. This is the S&P 500. And you can see that this, too, was a trend that was holding in place for a very long time, since 2011. And right here, you can see again, we had a bearish engulfing pattern. I'm just showing you all the signs that were, basically the writing on the wall before this happened, so that, again, we're not surprised by this, but many people are because they're not looking at the signs. 2 months ago, right here, at the beginning of June and the end of June, we had a bearish engulfing pattern on the monthly chart. Now, rarely do you see bearish engulfing patterns on the monthly chart. You see them often on the daily and weekly, but you don't see them all that often on a monthly chart. And so in June, we started to see these signals, and we started to pay attention to those signals. And our investors who follow the Option Oracle and the other trade alerts, we've been putting people on guard, raise your stops, lighten your positions. The option traders have been taking some bearish positions along the way as well. And what happens is, boom, we get a big month. This is a tremendous down month, but remember, it's not over yet. We still have a lot of month left in August. And my forecast, as I go into the weekly chart here now, my forecast is I believe this is the support level that we hit this morning. I believe we're going to see a little bit of a bounce off of this support level and try to maintain some kind of stability, maybe even go up a little bit. That's why I had this little hash mark here. My weekly forecast. I'll show you this. I'll show you on the diamonds. It's actually clear on the diamonds DIA. I'll show you this on the daily chart. My forecast was that we would come down a little bit. I'll zoom in here. This is what I said last week. You can go back and listen to the report that I put out on Friday. I said at the beginning of the week, we're probably going to go lower. That's why I had this. Did I think it was going to drop 1,000 points on Monday? No, but I did feel very strongly that we would go down on Monday and Tuesday, and that's what this line represents. And then eventually towards the end of the week, I think we're going to see a bounce and a possible move up to test that trend line once again. So do not hit the panic button. There's nothing wrong right now. This is a shakeout. It's a correction. It's China and everything else combined. It's an overextended market. Do not be afraid to even move to the sidelines if you have to, but don't be afraid to get in when you see these bounces. It's not going to be something that will just go straight down and all of a sudden we're down 5,000 points. It's not going to be like that. If you remember back in 2008, and I'll go back to show you this on the monthly chart again. In 2008, here we go. At the beginning stages, right here, I'll zoom in for you. The beginning stages of 2008, very, very similar to what we had today. Right here we had a little bit of a topping pattern, a monthly chart with a doji, which you don't see all that often. Very, very close to a bearish engulfing pattern here in November. And then look what happened. We had a big down month in January of 2008. And then what happened? Look, it bounced. Let me show you what I'm talking about here so you can see. I'm trying to connect it. So here's a trend line. This is from 2005 to 2008. This is a 3-year trend line. You see that? Then boom, we had a big down month. It closed below the trend line, and then what happened? It made a recovery to go back up and get over the trend line. You see that? And then what happened? The former trend line turned to resistance, and boom, that's when we had the big sell-off. So if we go back to present time, here we go. We have the beginning of the breakdown of the trend line. There's going to be some time, and I'm talking, I believe there's going to be possibly 2 to 3, maybe 4 months of trying to get back. But here's the big key, and this is the big but here. If we fail and it starts turning down from that trend line, folks, I'm telling you, I cannot be stronger in my message to you with regard to a caution flag being waved. If we turn down, and I think we will ultimately, from that trend line and we start going down, I call that the kiss of death. And what that means is we are now shifted into a very severe and aggressive bear market. And the reason this could be a bear market that's even more severe than 2008 is because if you look at the buildup from 2008, from 2002 rather, to 2008, you see this trend? This was a good 6-year trend. But here we have a more severe angle in the trend. It was a more aggressive trend. It's a slightly longer trend in time, and therefore the sell-off or the pullback from that could be a lot more severe. And again, don't be afraid of that because, listen, you could make more money on the way down if you learn how not to fight it. Don't try to force buy orders in a market like this. Just learn how to roll with it, learn how to get out, learn how to put your stops, but learn how to shift into a bear market strategy so that you can really feel more comfortable with that. Now finally, the VIX. I'm not going to get into the Qs because all the markets look pretty much the same. They really all look the same. Now remember down here, these were the 20-year lows that the VIX was hovering around in that report that I put out 2 years ago. This is the 20-year low that I was talking about, and we have been hovering around those lows below 15 for the longest time. and then look what happens in 1 week, in 1 day. Look at how amazing this is. 1 day, look at the VIX. I did call for a move up here on the VIX. Again, I didn't think it would go this extreme. I thought we would hit resistance right here. But if you look, I have to actually go back to the weekly chart to show what's happened today in the VIX. We really blew past these highs, I mean, in a significant way. But what happened is the VIX on the daily chart, ready for this? The VIX on the daily chart has left gaps. And this is going to be very, very important for you. And we're going to start looking at your individual stocks too. Chances are a lot of them have gapped as well. 100, this is an important statistic here, with regard to gaps and the VIX, 100% of all gaps have filled in the VIX. So if you go back in history and look at all the gaps, look, here's a gap, it gapped down. What did it do? It filled the gap, it came back up. Here's another one, it gapped up. What happened? Gap filled. Here's another one, it gapped up. What happened? Gap filled. Here's another one, gap down, gap filled. You see that? This is the only gap that's left that's unopened, or excuse me, that is open, unfilled. I do believe that the VIX is going to pull back and eventually fill that gap point right there. Now remember what I said at the very beginning of this presentation. The VIX is a contrarian indicator. So here's the big test question. If the VIX goes down, what does that mean for the S&P? Who wants to answer that? Is that bullish or bearish? If the VIX is going down, what are we most going to expect? Yes, Lloyd, Amelia, Steve, Jack, Lloyd, all of it. It's bullish. Now remember, that's short-term bullish. It's short-term bullish because here's why. If the VIX pulls back and the market goes up, once the VIX has filled this gap, there's an 85 to 90% chance it will bounce. And that's what this line represents that I drew last week. I did believe that the VIX will eventually pull back to fill this gap. Keep an eye on this, because once the gap fills, it will most likely cause the VIX to start to go back up again. That's when you have to be really careful of any long positions that you hold, because that is going to be bearish for the market. Okay, it's probably the longest I've taken in a very long time to give you the overall market. I still didn't talk about the Qs, the Russell 2000, but that's okay. You get the picture. We had a sell-off. It was driven by China. Some people are blaming it on Donald Trump. Whatever it is, it happened. And now, what do you have to do? You have to learn how to go with it and roll with the punches. Joe said the TVIX was up 37%. Joe, the question is, did you make money? Did you make money today? Well, you know what? Here's going back to my Twitter page. I put this alert out, and again, where is it? Here it is. Please go and watch what I put out. At 9:35 this morning, I did a quick video of the market opening. And what I did is I basically didn't want people to panic. When the market opened that low, it was a knee-jerk reaction to the news overnight in China. And we had a lot of people. I was talking to a couple of people who actually got long right after this report went out and was able to capture, get this, a 600-point bounce. After the market opened, it bounced 600 points before pulling back a little bit. And there were a lot of people that got in on the options, buying the diamonds, in the money calls, and making money on that. In fact, we made some money on silver this morning as well, because silver came off really hard. It gapped down. We played the gap in silver today, made some money there, and we were actually having a lot of fun while the rest of the world was panicking. Don't panic. There's lots of opportunity out there. Okay, I'd like to keep this pace going very quickly. I'm going to get right into the rapid fire stock analysis. So let's start looking at your stocks. And please, once you have put in your stock symbol, let me know what your position is or what your idea is. Larry is asking me to look at DUG. He bought it at 74.72. Let's take a look at that. DUG. Bought in at 74.72. Sell it. Yeah, I like that silence after that. Larry, I don't know when you're going to take a profit, but this is a daily chart, and that's a doji. a doji with a straight up move. Look at this. Boom, straight up, vertical. Where's the gap? It's going to most likely pull back to 75, right where you bought in. And I would take your profits right now, my friend, and I would run, and then I'll wait for another bounce. Now here, let me erase these lines, Larry. Everyone should be, again, if you have a stock symbol you want me to look at, I have so many stocks that I have to look at today. If you don't put what your price is or your idea, I'm going to skip it. Unfortunately, I have too many to go through. So let's go remove all drawings, and let me show you something, Larry. Here is a role reversal right there, all right? Former resistance, once broken on high volume, is now going to act as support. So what most likely is going to happen is this. I think it could even come all the way back to 70 before it bounces. Larry, I'm going to leave those lines on there, and hopefully you'll take your profits and make some money with that, okay? All right, now MO. Ron is long at 37.98. Let's look at MO. That's Altria Group, and you're long at 37. Okay, I would hold this one, Ron. And Ron, I'm gonna put you on the spot here. If you bought it at 37.98, which is below where the chart is, where is your stop? Where are you moving your stop to protect it? That's what I'd like to see on the chart. And I'm going to show you where I would put my stop right now. Here is a former resistance area right there. I'm going to draw my line starting from there and project to the right. Boom. Here we go. There's your role reversal. So, Ron, if you have a stop somewhere below 48, that would be good. What I think could happen is this. I think it could go right back up to fill that gap. Just like the general market, I believe will bounce. And then once the gap fills, I think that's going to happen. So I would trail your stop up, Ron, and once that gap fills at 54, even if it doesn't start turning down, Ron, I would sell half the position. This is me. I'm telling you what I would do if I had your position. These are my opinions. You can do whatever you want. That's your account, but these are my opinions. And I would sell half the position at 54, and then if it starts going down, I would sell the rest. If you get a green candle, I would ride the rest of the half of the position. So that's what I would do there. So hopefully you make some money on that one. You already are. Okay, Gary, what do you think? Yep. Here's a general question on Netflix. What do you think of the gap in the mid-70s? Now, NFLX is one we've traded quite a bit. It's really a very, very volatile stock. This one, again, look at the gaps. Here's a gap that already filled. It filled today. There's still, excuse me, two major gaps below the market. I think Netflix could very easily do a little bit of a bounce, but ultimately I think Netflix is going to tank to fill these gaps. So, Gary, if you have a position in that, I would really keep an eye on that one, because this stock below 100 is kind of like Apple below 100. People start to get nervous when they don't see a triple-digit share price on their account. So watch out for that one. Okay, Philip is looking at Apple. He's long 100 share, long at 100. He's long 1,000 shares. Man, you've got some guts, because look at Apple now. Apple has tanked, and I'll wait for the chart to open up. I've been watching Apple. Apple really broke through. Now, you're long at 100. Now, here's the thing, Philip. I don't know where your stop is, and I don't mean to rub salt in anyone's wounds here, but when you have a stock that has a gap right here, this was a gap that filled, and it didn't really bounce. So if you had it at 100, this would have been the area to get stopped out. And if you didn't get stopped out right now, you're now waiting for a bounce. This is what you're waiting for, to go back up to former support, which is now resistance. Now, I have to back this up to help you out, Philip, a little bit more, because if I go to the weekly chart, you'll see that there is a role reversal. You see that right there? There's your role reversal. It's a former resistance right there at that high. I don't know if this is coming through for you, but there's a high resistance, broke through resistance, held the support, and today that support held. So I think we're going to get a bounce because of what? What's my main sign? Who's going to tell me where my eyes are going right now? Who wants to do that? Look at this whole chart. Let's analyze this. What am I looking for? I see the price is going down. I see it, right? What am I looking for? Someone who's been on these calls long enough. Okay, look at that, Amelia and Lloyd. Yes, I want to look at volume. Now look what's happening with Apple. Philip, pay very close attention here. You had a bearish engulfing pattern. Boom, on the weekly chart, there's your first sell signal. A breakdown, a key roll reversal support right here. There's a second sell signal, right? But now, if we're seeing a drop in volume. So what that means is, as the sellers are pushing the stock down, the sellers are losing momentum. So if the sellers are losing momentum, that's bullish. Now here's my final thing. If you don't get that bounce, if it breaks down below 95, Philip, you need to get out. Otherwise that thing could really hurt you. I'd rather see you get out, because that thing could wind up down here at the next roll reversal, right around 72, or maybe a little bit better here, you got around 81 or so. That's how far Apple could drop if you continue to hold. And with 1,000 shares in your account, that's significant money. So be careful of that one. Okay, let's go back up. Alan, looking at Micron, I think MU is Micron, right? MU. So looking at Micron Technology, Alan is long it at 1722. Ouch. Okay, we're looking at a weekly chart. 1722. Alan, I'm not going to ask you where your stop is, because I'm guessing you don't have one. If I'm wrong, please correct me, and I'd love to see that. But look what's happening. You have 1722. You probably bought it recently. There's a gap up here that needs to be filled, but that's a pretty big gap. The good news for you, okay, Alan, ready for this? The good news is you have a small gap above the market, close to your buy price, and there's a resistance area up here as well. The good news is that you had a green candle, and the volume is increasing on the green candle. It slowed down on the previous candle from Friday, but you had higher volume today, which tells us that the buyers are coming in. Alan, I don't know how many shares you have. It doesn't matter, but just be careful. You need to put your stops in place. Use your stops. Okay. Ken, now we just looked at Apple, but Ken brought up an interesting question, and I'm going to go back to Apple because Ken is short a put, AAPL. Let me see, is that I had two A's there? Yeah, AAPL. Now, when you are short a put, and he's short a 101 put, when you are short a put, what that means is that you are obligated to buy the stock at the strike price. In this case, 101 is where Ken is obligated to buy the stock if it drops. Now, Ken, I like the idea of shorting a 101 put because you got a good chance of Apple bouncing right here. Now, I don't know what month, but here's what I would suggest to you. When Apple starts to move back up to retest this resistance area, you need to close your put. This is what I would do. I would close my put, take my profit on any pullback from 112.5. I would get out and take, if it's a profit, get out. And I think that's a fairly conservative position because Apple filled this gap down here, and 80% of the time after a gap fills, it generally reverses. So today it filled, and I think you could see a little bit of an uptick tomorrow and for the rest of the week. So make sure you're protecting your option positions as well from risk. Okay, Lloyd, AMT, long AMT. All right, what price? What is it? 96.82. American Tower, 96.82. Okay. The good news is, Lloyd, is that the stock really is right at that key support level from back here in October 2014. That is the good news. Okay. Another bit of good news for you, Lloyd, is that there is a gap right there, very close to where you bought it. Here's the bad news. Okay. This is what will most likely happen. Boom, it'll go up to fill the gap. 80% of the time after the gap fills, it reverses. That's your bad news. The bad news is that you have a chance to get out of break even, but I'm sure you want to make money. If it gets back up to that gap, you're going to feel, relief. Oh, I'm not losing any money anymore. I'm back to break even. And then you can get caught in that trap. Be really careful. Don't relax with that. I would pursue getting out of break even at that gap point, and then wait for the stock to find another stronger support level, and then once it pivots, you can get back in there. Okay, Stuart says, thinking about buying BIB. As a brave man, think about buying in one of the biggest down days in the U.S. stock market history, I think in the top 10, and think about buying. Okay, well, here's BIB. Is that a big sell-off? Sure, that's a vertical, free fall right there. There's no doubt about that. But here's what we can see. Just like the rest of the market, look what happened. Boom, boom, boom. There's your former trend line. Broke down below the trend line, failed to get back over the trend line. Kiss of death was right there. It came back down. Now what you have to look for is another key support level. Now here's what we got to do, Stuart. I'm going to open up the audience to help you with this. Can anyone look back to the left of my chart? Can anyone tell me, is there a role reversal support line that I can draw? And if so, what price would you draw it at? Ready? There's the clock ticking, tick-tock, tick-tock. Who would be brave enough to put a number out there? And I'll draw the line. Okay, Vlad says 45. Ken says 55. Nathan says 75. Well, support has to be somewhere below the stock, Nathan. So 75 would be more of a resistance area, but you're right. That's a role reversal resistance. This is what I'm looking for. Right there. Here's former resistance, broken. Here, former resistance is broken, turns into support right there. So if we extend it out, 55 is the magic number. Okay? That's the magic number right there. So 55 is support. So what's happening right now, Stuart, is that the stock is on support. But if you're thinking about buying it, you have to wait for the stock to bounce off of support. You need to see that. You need to see the pivot point. And as soon as you buy it on that next bounce over support, you need to put a stop very tightly below that support level. So if you buy it above support, the support line is your trigger. Once it starts breaking down below support, you need to get out. And that's the way you manage the risk. And that, by the way, is written in the 5 Points for Trading Success, which is our best-selling book that came out some years ago. Okay, I'm going as fast as I can. Stop at 90. Okay, that was Philip asking. It was on the other position, so you got your stop in. Okay, Amalia, volume. Okay, who's next stock? Danny. Okay, SWHC. SWHC. Oh, let's see. Hold on. This SWHC. There it is. Smith & Wesson. Now you would think when the world is falling apart, Smith & Wesson would sell more guns, right? But no, this one falls in sympathy with the rest of the market. That's called the domino effect. Here's the bad news, okay? Now, I'm going to give you the bad news first on this one because Smith & Wesson has gaps below the market, okay? So you have to really be careful with this one. And let's see, what is the, I just lost my place on there. All right, Smith & Wesson is got gaps down here. So I wouldn't be a buyer on this one just yet until this gap right around 13 starts to fill. There's a lot going on with these big gaps down here. I don't like to buy into stocks like that because there's just too much risk. Oh, Danny, I'm so sorry. You're shorted. Oh, okay, you're shorted at 1488. Okay, so this is what will most likely happen. Boom. It'll fill the gap and then bounce. So right around 13, I would get out, close it, cover your shorts, and move on. Be thankful you had a profit on that one. Okay, Tim. Well, look how nice that is. AJ, if you have time, can you look at CCJ? I'm going to make time for you, Tim. Yeah, I'm looking at life a little bit differently. I'm trying not to look at the clock. I'm just trying to be the most productive that I can while living as much life as I can in the middle of that. So let's look at let's look at CCJ. You're looking to buy in. Okay, now I'm telling you, Tim, I think this stock could bounce only because, and here's the only thing that I see. I have to actually show you this on a weekly chart. Here's why I think the stock could bounce. Actually, I'm going to do this a little bit differently. I'm going to do it from this high. As I'm doing this, tell me what for those who are market guy followers, tell me what this is. High, high, connecting those highs to this high, projecting out. That's line number one. What I'm going to do next is draw a line parallel. You see that? What is that called? Can anyone tell me? What is that called? It's a channel. Thank you, Joe. It's a downward channel. So the only thing that I see going here for you, Tim, is that the best that you can expect is a bounce off of the channel line. But guess what? If it bounces off the channel line, then it's still in a downward trend. So why not go look for a stock that's in an upward trading channel and go buy that one? That's my best advice for you. Don't buy stocks that are in significant downward trading channels, because chances are the traders are going to keep pushing it down. Okay, so Ken, you were out to November on that one. All right, good. All right, Joe says, want to hold on Apple being up 120%, plan to sell covered calls. All right, well, this is an option question, folks, so for those who don't trade options, take this as a little bit of a lesson. AAPL, gotta get rid of that. All right, let's see, AAPL. All right, if you are waiting for it to go back up, I would sell at the money calls or slightly in the money calls, Joe. You're going to collect a lot of premium. And if you look at these option prices, look at September, which is now the front month. Look at the at the money 103 calls. Look at that. With 4 weeks to go, these options are trading around 6 to 6.5. That's a lot of premium. So your best bet, if you want, is to learn diagonal spreads. Send me an email. I'll tell you a little bit about that, because we cover that in the option oracle. It's what's better than a covered call, Joe, is a diagonal spread. You still get to collect premium. You still get to make a profit from time decay. But what you do is you replace your stock position with something that's like the stock. In this case, you buy a deep in the money leap. It could be a call or a put. And I'd rather you wait for the market to rally than buy an in the money put and sell an at the money put. And you're still going to get a higher return on your investment with less risk. Why is it less risk? Because you're not putting up as much money. You're buying something that's like the stock, not the actual stock. Okay, let's go to Ron is looking at Love at Southwest Airlines, I believe, LUV. And let's go to the charts on that. I know LUV is, I know that's Southwest. There it is. Okay, so Ron is looking to buy Southwest. And what we have to watch out for is this. Boom, here's the low point right there. I'm going to connect to that low right there. I'm going to project out, trying to be as careful as I can to connecting that dot right there. Okay, Ron, what is that called? That's a kiss of death right there. See? Former trend line, broken, tried to recover, failed, boom. Southwest could wind up going down. Be really careful. Try to look for something that's less, I guess you could say, less bearish at this particular point, because you still have, this is a weekly chart, by the way, and the volume was increasing over the past 4 weeks as the stock is starting to go down. Very, very bearish. The only good thing, Ron, you know, I rarely talk mentally, but the good thing about the airline stocks right now is that if you look at OIH, for instance, that's the Oil Holders Trust. The oil, look at the price of oil. Bam, dropped. The biggest expense for airlines nowadays is the oil. So if the oil is half of what it was, it's less than half of what it was in July of last year, less than half, you would think that profits would be a lot higher, wouldn't you? But look at the correlation with the volume of oil that we see here. Look at the trade volume down here. This is massive volume as oil has been tanking. You would think that even like Delta, for instance, you would think Delta and you would think Southwest and all the other ones, United, you would think that they would be going up in direct proportion to the price of oil and the way it's coming down. And it's not. So what's happening is we have a bearish engulfing pattern here. Boom, there's a big bearish engulfing pattern in Delta. And if Delta is starting to go down, what do you think could happen with LUV? It can go down in sympathy with that. And we came very, very close to a bearish engulfing pattern last week. Not quite, but very, very close. So, Ron, I would stay away from that one. And this is being recorded, so keep tabs on what I say so that you could, again, learn this for yourself and learn how to get in and out of the market. Okay, let's see, looking for more stock symbols. All right, let's anyone have more stock symbols? You can go put them in right now. I'm cleared. I think I could clear out. Okay, so look at Vlad. Thank you, Vlad. SLV. Oh, that's SLW you're looking at. Okay. If you could, put in your intentions or what your position is. Again, this is silver Wheaton. It moves quite nicely. Silver Wheaton has amazing trading legs. And let me explain to you what a trading leg is. From this low to that high is an upward leg. From that high to that low is a downward leg. From that low to this high, upward leg, downward leg. I'm just going to draw these out so you can see the amount of movement that we see in SLW. Now, look at, it's kind of like if you were looking at an EKG, right? What do you see? Boom. That's what I think. Look at the timelines. Look at how regular these peaks are, and look at how regular or timed these troughs are, peaks and troughs, right? You look at the timeline. There's cycles here. 1, 2, 3, and it's almost as though every month and a half to 2 months, almost. Look at this. The beginning of July 2013 hit a low. 2 months later, right there. This is 1, 2, 3. Oh, that's more than 2 months. This is 3 months. July, October, July, September, October. Okay, there's 3 months. These are 3-month cycles. And if you look, we're right in between cycles here. So you give it that cycle line, there's a very good chance that SLW is going to start to rally here. That's number one. Number two, as I erase my lines, I had the calendar wrong on there before, but I'm going to erase these lines, and I'm going to show you something a little bit closer. Here's a downward move, right? Boom, boom, downward move. What's happening to the volume? Going down, right? Is that bullish or bearish? Well, this is going down. If the volume drops, it's bullish. This is a weekly chart. Now let's look at the daily chart. Boom. Here we go. Major support level right there. This is a very low support. But look at the volume. Now this is key. Think about this for a second. This is a big institutional holding. And if the institutions were selling out, the volumes would have been here. There would have been sustained volumes. But what's happening is now the stock is basing. It's in a sideways trading channel. And the volume here is holding steady at higher levels. This tells me accumulation. We're consolidating and we're accumulating right in here. So I'm very, very bullish on silver Wheaton, SLW. I'm very bullish because what's happening right now is that if there's a currency concern or a fear, especially in the bond market, if you look what happened in bonds, amazing numbers, trillions of dollars, being traded. You have a currency, basically, silver, could be the safe haven when people really get stressed out. So I think that with silver production being as low as it is, because the cost of mining silver is still around $20, $17 to $20 to pull it out of the ground. The miners are slowing down production because they're losing money to process the mines and to process the silver. So they could buy it cheaper in the market than they can pull it out of the ground, so they're going to stop production. That's number one. Number two, if you buy into SLW, I would get out right here, right around 17. Can you see the gap right there? Boom, there's a gap there. And there's a small gap, it's hard to see, there's a small gap up there around 23. So I think SLW is a great candidate. Put your stop, I would put your stop probably around 11.5. Put it like maybe $1 risk per share, and then move on from there. Okay, Mike. Mike, do you have a position in KMI? No, I'll see. I'll take a look there. KMI, Kinder Morgan. Let's see. This is another tough one because you got it's looking a lot like the market, but what's happening is look at this major wave of downturn. I have to now switch to the weekly chart, maybe even the monthly chart, to see where there might be support. There's no support on the weekly chart because it's below previous support. Let's go to the wow. This is 1, 2, 3, 4. Well, here's what you have to do, Mike. You got to wait on this one because you had a bearish engulfing pattern and you have 4 successive months of red candles, and these are big, long red candles. These are not small ones. That's number one. So the way I'm reading this is bearish engulfing pattern with a significant red candle, a longer red candle, then a longer red candle after that, and this is an even longer red candle. So you might have to wait a couple of maybe a week or two and see if this starts to go up. If you get a long shadow, which is just a long vertical line underneath that candle, if you get a long shadow, that actually becomes bullish. Very similar to what you have back here. See this big, that's a big red candle, but look at the long shadow underneath. These long shadows, see these back here? Those are very bullish. So I would wait for that shadow to get longer, which would mean you're going to have to wait till the end of this month before that candle holds, and then you can maybe think about buying it. If you do buy it, let me just erase these lines, hold on. If you do buy the stock, you have to put a stop below any kind of support that you have. The only support that I see is, see how it went up here? This is a minor resistance area right there. And if I say, okay, resistance when it's broken turns to support, your only support is right there around 30. So if you buy it a little bit higher, and I know this sounds crazy, but you actually have to wait for the stock to go higher before it's safe to buy it. I would buy it and then put your stop below 30, and then I would leave it. But this is still troubling because you have that major red, increasing in length red candles. That's not good. So wait. Okay. So gold, do gold. All right, Bruce, are you take a position in gold? All right. Again, try. I'm going to have to start skipping over the ones that don't have a price or anything because we got more stock symbols coming in and we're running out of time there. So let's look at GLD. Gold, like silver, has been very volatile, and this again is a monthly chart on gold. Monthly. Here's former resistance, broken, is now support. There's major support on GLD at 100. And it looks to me like if gold rallies any further than where it is right now, you're going to have a bullish engulfing pattern. The only thing that's stopping this from being a bullish engulfing pattern is gold needs to get up to 112.60. If it gets up to 112.60, which is this high from last month, is 112.58. The top of this candle has to be has to close over the high here, or over the body there. So I would say if you get a bullish engulfing pattern, load up on that on the monthly chart. Remember, the monthly bullish engulfing patterns are very, very powerful. And even then, if you do decide to buy it, you have to wait for, see, because the daily chart's showing a bearish engulfing pattern, the monthly chart's showing close to a bullish engulfing pattern. So you really have to wait on this one, because this is what I think gold could do. I think gold could drop over the next couple of days. I think it could go even as far down as here, right around 107. And then I think it could bounce. Now, if this happens, if that happens, if this gap and this gap fills, what is this whole pattern called? Can anyone tell me? Right here and here. Who's been following the charts? Let's see. Anyone going to answer that one? I know there's some technicians out there. There you go. Sophie, thank you. Vlad, Jeff, Ken, Steve, yes. That's why you have to wait on this one. Once these gaps fill, there's a good chance it'll reverse and go back up, and then, boom, you got your cup and handle. Cup and handles are very, very reliable, but you have to wait for them to break. So this is another one where you have to have patience with this one, and any kind of a trade or breakout over 112 becomes extremely bullish for GLD. Okay, so hopefully that helps you out there, Bruce, and you make some money with that one. Okay, I have enough time for a few more. Sean says MKTO. MKTO, he's thinking about going long. And you're very close to that, Sean. Very close, but not quite there yet. Here's what you got to wait for. You actually have to wait for that gap to fill. Once that gap fills, boom, there's an 80% chance that it'll bounce. If it bounces, your next resistance point's up there around 31, right around 29.5 actually. So you don't have a whole lot of room on this one. But, Sean, if you do buy it on that pivot point down here after the gap fills, you're going to have to put a tight stop right there, because this one is extremely volatile, as you can see. Lots of movement. I mean, it went from 35 all the way down to 25 in just, what, 2 weeks. So you got to be really, really careful with this one. Highly volatile. All right, Alan, MLR, you're considering taking a long position there, and MLR, that is Miller Industries. Again, just like we were looking at MKTL with Sean, you have to wait for this gap to fill. If you buy here, yeah, there's a chance it could go up and fill this gap, but you're not talking about a whole lot of money here. It's, as soon as this gap fills, it's going to come right back down. But the thing is, you don't know which gap is going to fill first. So that's the trick. When you have a stock that's caught between gaps like this one is, it's a 50-50 shot that it can go up or down, because you're getting drawn up and down on these gaps. So I would say the safe thing to do is to wait for the gap to fill right around 1840, wait for a pivot point, and then get in, and then put your stop somewhere below that low. That's the way I would play that one. All right, let's see. Okay, looks like I got a question coming over from Jared on my phone though. Let's see. Is Jared on here? And if so, I'm going to answer his question. If not, yeah, Jared. All right, I'll answer your question. Okay, Jared's question is, on a 401k, at what point would you move from stable to high risk? 0. Jared, I would not move anything in a retirement account to a high risk position. I would not do that. I have to tell you, your 401k is your retirement. That's where you should be stable. That's where you should be investing, not trading. What I'm talking about right here is trading strategies. 401k, I mean, I like a lot of 401ks, especially if they have the feature, and this was after the crash of 2008, a lot of employers were basically mandated by Congress to provide an exit strategy where you could at least move to cash. I would suggest that if you have a 401k, I would not be in any major positions that have Dow components or anything that's long in this market. Look for funds that have precious metals in them. Look for funds that may even have high dividend stocks of some sort. I would not be putting any retirement money in this market right now, because we're getting ready to roll over. All right, Jared, hopefully that helped you. Okay, DE. Rick, this will be the last one here, because I'm going to do a wrap-up here to help everyone out. DE, is that John Deere? I think it is, right? Yeah, Deere & Company. Okay. long and it's 75. Now, here's my question, Rick. If I don't know when you got long it, unless it was today. Did you get long it today? I'd love to have a conversation with Rick here for a second. Rick, did you get long this today? Maybe on the opening? Because the only other time I see it trading down anywhere near your price is last year. So let's see. If you're long, oh, you got long 2 years ago. Okay. Now, here's my question, Rick, and I'm singling you out because I know there's a lot of other people that are in a position like yours. When you have a stock that's been going up steadily, like this has, John Deere, and I love John Deere. I have a John Deere tractor, and everything is green in my ranch out west. At what point do you say, okay, I'm going to move my stop up? Now, here's the strategy. When you're tracking a stock, if it's in an upward trend, and you can clearly draw a trend line like this, each and every time the stock bounces off of a trend line, you need to put a stop under the trend line. Then you wait for it. It's okay if it goes up and comes back down. If it bounces off the trend line again, you move your stop from here to here. That's basically you're telling your broker, get me out if it breaks down. Then it bounces off the trend line again, boom, you move your stop. This is called trailing the stop. Every single time it bounces off the trend line, you should trail your stop. Now let's say you've done that 5 times, and you're at this point where your stop is right here. You would have been stopped out 2 days ago. You've been stopped out on Thursday, and you would have saved a lot of heartache in watching some of those profits go away. Trailing the stop is extremely important. Now, with that said, here's what I think could happen with John Deere. I'm going to leave all these other lines. I'm going to leave those lines up there. Okay. Here's what I think could happen. I think you're going to get a bounce just like the rest of the market will bounce. And I do think it could actually get back up to around $10 to rally around $10 to 90. And this is what I think could happen with John Deere. I think it could pull back from this gap. Okay. So, Rick, if it gets back up and does what I say right here, trail your stop. Do it now, and then as it goes up, continue to move your stop up every $2 or every $3. And don't worry if the market causes you to get out. Don't worry. In other words, don't worry if the stop loss gets triggered, because you'll take your profits. Here's why I'm concerned for you, is that, look, we have a topping pattern here. This is called the complex head and shoulders pattern. Boom, boom, boom. I'm going to draw it out for you. It looks like an M, right? Like a weird. You have right here. This right here, this $80 level is called the neckline. If it breaks down, if it goes below that neckline, it could drop dramatically. It could actually do exactly what we saw in 2008. So I would love to see you at least lock in a profit, and I would hate to see you turn such a great winner into a loss. That's not what we want to do. We want to make money. We don't want to lose money. And finally, if you want to make a lot of money in the market, just don't lose a lot of money in the market. I mean, that sounds ridiculous, but that's how it works. Okay, folks, finally, make sure you go to Twitter. All you have to do is follow me there, and I promise you I'm going to provide value. I was John Nigerian from CNBC. He's going to be hosting Halftime Report tomorrow, and he and his brother Pete really put on a good show on CNBC. I had dinner with John last week. Actually, this what was it? Wednesday. I flew up to New York. I had dinner with John. He's a great guy to follow. He's down to earth. He loves options. Stay connected to me on Twitter, and I give you my word, I'm only going to provide value and education on that page. That's what I'm going to do. Every one of my tweets is going to be something that will help you. So all you have to do is click the follow button, and if you don't go on Twitter but you want to go on Facebook, then you can go follow me on The Market Guys, and I'll do the same thing. I post the weekly market report on there as well. Every week it comes out. My partner Bill Shanley, who's recording this, will what he does is he adds the nice music and the graphics and everything, and we put that out for you so that you can get your weekly update And again, it's all for free. And then finally, if you go to themarketguys.com, www.themarketguys.com, there's a video link right here. See that? And there's a video library where you can learn all about the things that I've talked about, the rubber band effect, talk about role reversal. This is an important one right here, trading the gap. These are 3 to 4 minute educational, more or less, we call them market shots. You'll get the information so that you can learn how to read these charts and be in control of your money and not have to worry. Jared, learn technical analysis, because even if you're planning for your retirement and you don't know what to do with your money in your 401k, if the charts are telling you things are getting bearish, you could pick up the phone, call your employer and say, listen, I want to move to cash. I'm not feeling so good about this market. Then they sell you out. You wait in cash. You're preserving your money and protecting your retirement. That's what it's all about, risk management. Folks, I had a great time. It's 9 o'clock right on the dot. And I hope you enjoyed it. I certainly did. And I look forward to a next web seminar, which comes out every month. So stay tuned, and we'll talk to you later. Bye-bye.